All right, so okay, let's get started. Well, what a ride. It's been almost 2.5 years since the first closures, and the roller coaster just seems to keep going. Once the pandemic hit, we started with full lockdowns and a significant impact to the housing market. Then came a slow, staggered opening of the economy. Government support programs like income support and other programs, but also historically low interest rates. And the housing market was on fire pretty much across the entire country with incredible house price growth levels. Now we've reopened, however, we still have lingering impacts of the pandemic on supply chain and other factors like high inflation, rising interest rates as the government tries to control inflation, and the resulting impact on housing affordability. Thus, the title of our webinar and what we will cover today, there is a chill in the air, both literally and figuratively. And the big question about surging interest rates and the coming lull in the housing market. Our speaker will cover the shifting landscape and what it means for the Canadian housing market and house prices. He'll do this by digging into the RPS House Price Index and the RPS Moody's Analytics House Price Forecasts. But before we get into the sessions, two quick things. First, let me take a minute to tell you about the RPS HPI and the forecasts. The RPS HPI provides a historical and current view of house prices and trends nationally. It's a broad, deep, and detailed view of the market, helping users understand how condos in Liberty Village are doing versus single-family detached homes in Forest Hill, as an example. The forecast, in contrast, provide a forward-looking view. They cover multiple scenarios and geographies, like our HPI. The forecasts are built using macroeconomic models, such as housing supply-demand dynamics, and much more. Created in 2014, the forecasts are the most authoritative forecasts available and combine the strength of two companies. Moody's Analytics brings extensive international experience as a leader in regional economic forecasting, and RPS brings its valuations, data analytics, and expertise in the Canadian marketplace. These solutions are being used by major financial lending institutions to assess, analyze, report on, and understand risks and opportunities within their portfolios. Second item before we get into the presentation, a few housekeeping items. We'll be recording this session. We will share the recording and presentation deck with you. We will also be placing you on mute during the webinar. You will have the ability to ask questions via the chat feature. If you have any technical difficulties, let us know in the chat tool and we will do our best to help you out. We have approximately 40 minutes for the presentation, then 5 to 2 minutes for the question and answer. So really now the reason we're all here, our presenter, Brendan LaCerda. Brendan is a director with the Economic Research Group at Moody's Analytics. He spends a lot of time working with the data and thinking about the economy and the Canadian housing market. He generates insights that are very useful and for those trying to assess what is happening and will likely happen. He has a unique and very entertaining approach to sharing it. So with that, I'll leave it to you to take it from here, Brendan.
Oh, Craig, thank you so much for that introduction. I was told we might be pushing a new record for attendance at our Housing Outlook webinar. So I don't know if my popularity is growing or concerns about the housing market have increased significantly. Well, I guess we'll never know. But of course, likely the latter, because we are clearly headed for a rough year ahead in the housing market. You know, I don't want to sugarcoat it on one hand, but you know, also I don't think there's any benefit to, report more doom and gloom than we're actually expecting. In terms of a rough agenda for today's talk, I'm the only speaker today, so I'm going to focus on the macro and housing outlook. And as Craig said, we'll have a Q&A session at the end. In terms of what I want to address in the macro and housing outlook, I want to start with a bird's eye view, talk about how that macro landscape has shifted and turned much harsher, especially in terms of housing. Additionally, we want to talk internally about what's going on in the Canadian housing market. Some of those idiosyncrasies, we need to explore in order to understand why our baseline outlook for the Canadian housing market is relatively worse compared to a lot of, sort of the advanced economy peers. I really, today's presentation wouldn't be complete without sort of sharing some of our hard numbers for where we expect the housing market to go. And I want to wrap up today by talking about some of the risks, some of the things where, I have to make assumptions about how the forecast is going to evolve. Whether it's military conflict in Europe or, COVID-19, those issues are, and those risks are very, still with us. So as I said before, starting with a, bird's eye view, taking into account the big macroeconomic picture, I think the best place to start is to think about, the Bank of Canada's dilemma. Put yourself in their shoes, and if you had to make these same decisions. The challenge for the bank at the moment, of course, is inflation. When I talk about inflation, I always prefer to break it down into its 4 key components. So it's energy, food, what we call core goods, and core services. The Bank of Canada has no control over energy and food prices. They don't control the rainfall in British Columbia, and they don't control what the Kingdom of Saudi Arabia decides to put out. Core goods and core services are where it really matters for the bank. When I say core goods, I'm talking about, vehicles, appliances, things of that sort. Generally, that's kind of good news there. We expect supply chains are going to be improving. Demand for those household appliances and vehicles is going to soften, so those prices are expected to come down. Really the key issue is core services, because that is actually the bulk of inflation. So when we calculate CPI, core services is the bulk of that. And those core services prices are tied to wages. That's labor. That's the biggest component that goes into core services. Right now, wage growth is running around 5%. That's the dark blue line you see. That wage growth is much higher than we historically see. How did we get there? Really low unemployment. That's the key. Record low unemployment. There's a worker shortage, and that pushes on wage growth. But, we can't continue to have this, 7% rate of inflation that we have right now. Just to put some perspective on how destructive that is, if the price of something grows at 7% per year, the price of it will double every 10 years. Conversely, the Bank of Canada's 2% target for inflation, if prices are growing at 2% per year, then prices only double every 35 years. So that's sort of, the old story of, compounded interest about, there's a huge difference between 2% inflation and 7% inflation. So how does the Bank of Canada get the economy back to 2% inflation? Well, the theory is you need wage growth of about 2.5% in order to get, 2% inflation. And realistically, how is wage growth going to slow? Well, either you get, a big increase in the supply of new workers, a big increase in labor force participation, or you get an increase in unemployment. One of those factors is going to have to rise in order to push wages down. And the trouble is, it seems, more and more that's going to come from an increase in unemployment than an increase on the supply side. So that's the challenge essentially for the bank, is that wage growth has to cool in order for us to get back to, the comfortable rate of inflation. So how do they do that? They push up interest rates. Interest rates push down demand, and the result of that, part of the result of that is an increase in unemployment. So where exactly are rates going? By our latest October baseline, we anticipate the Bank of Canada going to 4.5% on its overnight rate. We're at 3.25% now. We're expecting a 50 basis point increase in October, another 50 basis point increase in December, and then the final hike comes in January at 25 basis points. So roughly sort of a steady de-escalation in the pace of these interest rate increases. And the reason we halt at 4.5 in early 2023 is because that is when we expect the economy to enter a very mild recession. So this is an update to our latest October baseline. We had an upward revision to interest rates, and with the compounding risks, growth is slowing and slowing and slowing, and it's finally gotten to the point where we get very small negatives for GDP in the first half of 2023. So right now, we're not expecting what you would traditionally think of as a recession, but a significant slowdown in growth. And that's coming from this increase in the interest rates. So the Bank of Canada is planning to what we call overshoot. The long run equilibrium of where that policy rate should be, we estimate that to be about 2.5%. So, going up to 4.5%, that is going to significantly slow down growth. And as you see, sort of the corollary of the increasing overnight rate is an increase in mortgage rates. On average, the difference between these two should be about 300 basis points, which means that we expect mortgage rates to top out in the high 6%, maybe even close to 7%. Well, we'll pause from looking at pictures for a second, and I don't do this too often, but we'll switch over and actually crunch the numbers on what these interest rate increases mean. So let's wind back the clock to January 2020, before this all started, right before the start of the pandemic. Median home price in Canada, according to RPS, is about $588,000. The prevailing 5-year mortgage rate was about 4.1. And if you put 20% down, that's going to yield a monthly payment about just principal and interest. That would yield a payment of about $2,500. And then, of course, if you add in all the mortgage rules and say, if you add it, so what I did in this calculation was I just assumed $1,000 a month for taxes, insurance, HOA, condo fees, all the other ownership costs that go with the home. So we just put that number at $1,000 a month. That's how we get the minimum qualifying income level. What really makes this so dramatic is just fast forwarding from January 2020 to January 21. And the reason I chose this date is because that's when mortgage rates roughly bottomed out. So even though prices increased, the median price increased by almost $100,000, because of the decrease in mortgage rates, the monthly payment on that home was effectively unchanged. But fast forward to today, or roughly the latest data we have, the median home price in Canada to buy that same exact house today is now $867,000. And in August, the prevailing mortgage rate was 5.6%, which now is yielding a monthly payment of nearly $4,300. And if we break down that increase of roughly $1,700 increase in the monthly payment from the start of 2021 to today, 950 of that 1,700 increase is just interest cost. It's only a 750 increase on the principal. So the majority of this increase in the monthly payment is coming from interest rates. Now, it gets even a little more unsettling when you think about, hypothetically, the Bank of Canada goes to 4.5%. What if you run all these numbers with a 5% mortgage or 7% mortgage rate? Then, we're basically seeing that, compared to before the pandemic, the monthly payment on that same exact house, that median home, would be about double, what it was, almost 2 years ago. This I think speaks, the reason I run through all this math, because I think it speaks to, how rapidly conditions in the market have shifted for potential buyers, and how much, this, change in price and interest rate is impacting buying decisions. And, it's if you think about those numbers, it's not going to come as too much surprise that there's been a really rapid escalation in the amount of leverage. So, these are some of the numbers the Bank of Canada looks at closely. This is the share of new mortgages issued in each of these quarters with a loan to income ratio greater than 450%. So taking your gross, taking the size of the loan on the home, dividing by gross income. This is a sort of very troubling escalation in the amount of leverage. If we run through, if we sort of take those numbers from the previous slide again, think about that $867,000 home. If you put 20% down, you're borrowing about $700,000. If you have an LTI of 450%, that means your income is about $155,000. So in a roughly $870,000 home being purchased by a household with about $150,000 in income, if you look at that monthly payment, that monthly payment on that house, just the principal and interest is would consume about 44% of this individual's post-tax income. And that's clearly a sort of troubling amount of debt burden for someone to take on. And then you sort of add on to the fact you see here that there's a large increase in the number of people taking variable interest rate loans. The payments on those have certainly increased. And just you can see sort of the scale of things where up to a quarter of newly issued mortgages in early 2022 were carrying these very high loan to income ratios. So looking ahead, I think it's sort of building up this picture of there's clearly these factors moving against the housing market. Looking ahead, I think there's two big hurdles we have to think about the economy crossing over. And the first one I'll point to is the Bank of Canada's affordability index. So what they do is they're essentially trying to calculate, if a buyer went out and you tried to buy that current median home and you paid the prevailing mortgage rate, and you looked at you also added in other ownership costs like utility bills, taxes, insurance, all those things I mentioned before, and you divide it by disposable after-tax income. What we're seeing here is affordability as measured by the Bank of Canada, by this index. The affordability is already at its worst point since the late 1980s, early 90s. So the worst, in terms of affordability, the worst market in 30 years. Once we add in the additional interest rate increases, the additional damage to incomes from this expected increase in unemployment, realistically, it's probably looking like the least affordable market in about 40 years. So the implication of this is, buyers aren't going to return to the market in force until after we pass this peak. So that is why we are, roughly, pinning the downturn or the trough or the bottom for the housing market is late 23, early 24, because that's when this measure is going to peak, sort of the worst moment in the market for potential buyers. But even on the other side of this, even as this measure starts to improve, there is another factor we have to take into account, which is all this debt we've been accumulating over the past decade is going to be resetting at higher interest rates. So as all the mortgages taken out during the 2016 housing boom and the pandemic housing boom, and credit card interest rates and things of that sort, as all those interest rates push higher and reset to higher levels, the share of households' incomes that they're going to be using to service their debt and service their interest payments is going to be one of the highest shares of their income since, as we said before, the early 90s. This part of the story, I think, is more about the housing market's effect on the broader economy. So I oftentimes get asked this question when thinking about housing market scenarios, because you can think about it in two directions, which is problems with interest rates, problems with the labor market. How does that impact house prices? Or conversely, sometimes people think about it as if something bad happened in housing, big drop in prices, big drop in investment. How does that affect the rest of the economy? And I think these sort of two lines sort of try to demonstrate how it does work in both directions. That the darker blue line here is what's going on in the rest of the economy. What does that impact to housing? Where the lighter blue line speaks more towards the issues with housing and mortgage debt, how does that affect the broader economy? But ultimately, bottom line, if you sort of put these two things together, what it means is that roughly we think the housing market's going to bottom out late 23, early 2014. But a slow recovery at first because of these debt issues, before we get back to something more historically average. As I said before, let's put some hard data to these forecasts. In our baseline forecast, if we put in the mortgage rate increases, the rise in unemployment, the issues with affordability and overvaluation, and also the problems with household balance sheets and sort of those high LTI, those high household debt levels. Our expectation is that from today, prices will fall about 12% before they hit bottom in early 2024. So that's the dark blue line there, our baseline forecast for the Canadian housing market. As you can see, even in our upside scenarios, where we do have lower interest rates and a more rapid return of inflation back to 2%, even there you can see the housing market has to take a pause for over a year before appreciation resumes. But really, I think the clear feature of this chart is I would say the amount to which it skews to the downside. That how large some of the drops could be in some of these downside scenarios. One thing I will comment on, I included one scenario here, the Bank of England PRA scenario. So that's a stress scenario that
We seem to have maybe lost Brendan for a moment, but we're going to try to get him back. So please hang tight.
before I move on. With these downside scenarios, some people might say, our bank is doing, a 40% downside stress, maybe some other, larger numbers than we have. As I just said when I was describing that downside scenario, higher inflation and higher interest rates is one of the key components of that. One thing to consider is, if we have supply chain issues, more inflation, that also pushes up on construction costs, which would have the combined effect of causing an even more dramatic slowdown in permitting starts, new construction, and it would make that new construction, the materials, the labor, even more expensive. So part of what mitigates the decline in these house price scenarios is the inflationary environment that's pushing up on all these costs. So, there isn't this, glut of cheap new homes hitting the market, which is all just a really sort of long way of saying that, even in that, there's sort of that whole, the reason that house prices don't decline by more in some of our downside scenarios is for reasons that, on their own are bad. Namely, it's exacerbating like the issues of shortages in the housing market. So I can perfectly understand, I think it's reasonable if you want to consider, like a 40% decline in your most severe downside scenarios. But, in order to tell that story, there has to be, big inflation increases and big interest rate increases which can imply these sort of bizarre offsetting effects. All right, so every time I always say the national decline, we expect 12% peak to trough decline. As my mom always asks, but what about my house? So that's why I like to show the distribution of those declines. So what we're looking at here is I took all 33 metro areas in Canada, and I computed their year-over-year house price growth in each quarter. And then I cluster them, put them together in bins according to these intervals, -10 to 0, -20 to -10, cluster them all. Because what you sort of, it provides a helpful, visual of, you can see how just, on fire the housing market was in 2021. You see those dark green sections where, you're talking about like a third of metros in the country were recording year-over-year house price growth in the 30 to 40% range, or 30 or more. Just, the entire market, marching in one direction. In some metros, clearly just, blowing past others. Looking ahead, we see that same variation. And as I start to talk more and more about the outlook, I think, a helpful way to think about it is we're going to be clustering these metros into roughly, so what I'm saying is like 3 different fates. There's one group, you can see sort of those light green bars continuing. There are some metros where, we still expect they can maintain year-over-year growth. They might have a couple bad months here or there, but year-over-year, they will always stay positive. The bulk of the country is in that light orange section there. So that's why, we're getting, a 12% decline or so. Bulk of metro areas in the country, high single-digit losses, 10% losses. But there is a sizable portion, and you see it right really around like end of 2023. A large share of metros with price declines in the 10 to 20% range. So it's worthwhile, I guess. We should name names here. So who are we putting in these 3 different buckets? The high performers tend to be out west in the prairie provinces, Saskatoons, your Calgarys, your Edmontons. A couple factors are working in their play. Most of all, it's affordability. I didn't include the slide in this presentation, I think because I showed it last time. But if you just look at, prices relative to, median income in these areas, the prairie provinces, these major metros out there are just far, far, far more affordable than the rest of the country. And, given this interest rate environment, as I've said before, and I'll say again, affordability is king. Also, it's clear that elevated commodity prices have been a big income boost to these areas. Just the other day, I was writing a regional report on Calgary, and whereas we've seen a little bit of labor market trouble in the rest of the country, Alberta, Calgary, Edmonton, we're still seeing really solid hiring numbers. So we expect those markets will be able to escape this slowdown without any declines. The majority of the country falls in the section of highlighted blue. You can see the big metros are there, Toronto, Vancouver, Ottawa, roughly pacing the national average. It's the point of most concern are some of the metros I highlighted down at the bottom in orange. I'll start with Abbotsford and Halifax. Returning to that issue of affordability, these are 2 of the markets that saw some of the biggest price gains during the pandemic. I'm trying to recall off the top of my head, but I think Abbotsford was up like 70, 80% since the start of the pandemic. Our story is basically, local incomes and local demographics can't continue to support those valuations. Those valuations were driven by, a huge influx of people, moving out of Vancouver into Abbotsford, or, moving out of Ontario and Quebec into Halifax. A lot of that dynamics already played out. So, there's not going to be another big wave of, remote workers that are going to keep pouring into these metro areas with their higher than average incomes that allow the market to maintain these lofty elevations. So for Abbotsford and Halifax, that's really a story of, oftentimes, what goes up the fastest comes down the fastest. Montreal's a bit of a curious case. I will have to say that, Montreal always tends to score a little poorly with our housing model. A lot of it stems from the fact that Montreal tends to have like weaker demographics, population growth than the rest of the country. So I'm a little bit of caution. I think sometimes our model is always a little too pessimistic about Montreal. But I would say, I think Montreal's, housing market concerns are probably going to play out more over the long run because of those demographic issues. We talked a little bit about, the breakdown by geography. I think it's also going to be helpful to talk a little bit about, the breakdown by property type. So, obviously, what we saw, during the pandemic was a, significant divergence in performance across different property prices. I'll sort of highlight Vancouver. So, you see, multifamily, single family, roughly, moving in line. But, once the start of the pandemic comes in early 2022, these markets diverge wildly with, obviously single family accelerating much more than the multifamily. And the same things, plays out in Toronto. Looking ahead, though, you see that there isn't a ton of deviation across property types. That largely stems from the fact that, much of what is going to affect the housing market in the year ahead are cyclical forces, which are, interest rates and the unemployment rate. Those cyclical forces, tend to, really not favor, one type of housing, much more than another type of housing. I want to contrast that with, the pandemic period, where you have really a structural change in the housing market, where consumers' tastes and preferences are changing. They want to get out of the city apartment, they want to buy, the bigger home in the suburbs. That, that type of dynamic is not going to be a big feature of, this coming business cycle. Generally, what you see, and there's a little bit of divergence in the forecast. Sort of one thing to note is, for Vancouver, we see single family, re-accelerate ahead of the multifamily market. I'll talk a little bit more about that in a second. We do see, if you see where the prices bottom out, we are seeing, slightly larger declines in the single family market than the apartment market. And as I said before, that stems from the overvaluation issue. And then also, interesting in Calgary, we see, we expect single family home prices to slow below the multifamily market, which I think, all sort of makes a little more sense, because more so, with comparing, performance across property types, it's really important to look at the breakdown of, what type of supply is coming on the market. So there's a lot of lines moving around here. So I'll sort of direct you in the places you should look. The first thing I'll note is let's compare the performance of Ontario and British Columbia's single family markets. So this is the dark blue line and the solid blue line and the solid green line. And just to sort of be clear, what I'm measuring here in this picture is the number of units currently under construction in these provinces. And I'm comparing, where it's currently at to the 2016 to 2019 average. So trying to say, what is the current sort of amount of supply that's about to come on the market compared to sort of the historical sort of a long run, pace of construction. And, what we see at the, comparing the British Columbia to Ontario single family is, at the pre-pandemic, the market was sort of heavily, building a lot of multifamily units, and the number of new single family units was, sort of very minimal, 20% below its historical average. Really, a tale of two provinces where, once prices start escalating, supply responds in Ontario. You see, a dramatic pickup in the amount of single family. British Columbia, not the same case. There is really no change in the amount of single family construction going on in British Columbia at the moment. That is what, really gives that boost to the Vancouver single family market on the other side of this business cycle. It's a supply shortage issue, less so than, what's going on with the demand side of the market. Also, see the Alabama or the Alberta and the Alberta single family market compared to the Alberta multifamily market. So there I'm comparing the dashed orange line with the dashed solid line. There we can see that, a lot of sort of weak pace of construction, into 2020, 2021. One of the things to keep in mind is that, Alberta was still recovering from the 2015 commodity crash when, the 2020 pandemic hit. That is a big reason why, Alberta, we didn't see prices, take off at the start of the pandemic because, the labor market just wasn't in as good a shape as, it was in Ontario or British Columbia. Going forward, though, we see, there's been a dramatic increase in the amount of single-family construction in Alberta, much more so than multifamily. And it's this big increase in the single-family construction that's sort of moderating our views for single-family prices in Alberta. One last thing I'll mention is, we see, just the sheer volume of multifamily construction in Ontario. The dashed green line here. The number of new multifamily units going up is 50% higher than it was in the preceding 5 years. Obviously, this raises concerns about, is the market going to be able to absorb, this much supply? I think those concerns are very warranted. We're watching absorption rates very closely. So I will say, while this does present a risk in the short run from this inventory overhang, I think what it does speak to is, the really strong demographics of Ontario. That, in the long run, I think the housing market, will do well. And that, all these units currently being built, they're going to find owners, they're going to find renters. It may take some time, but, given the demographics, I'm not too concerned. I'll just, wrap up today with one final slide. So, when we make our forecast and we think about, our different scenarios, I oftentimes describe our approach as this hybrid, this hybrid method. So, we look at the historical variation. How much have prices gone up? How much have prices gone down? What lessons can history tell me? We also, use our models to, run simulations where, you can plug in, what if scenarios into the model, to look at things that have never happened before, things that, we haven't, we can't observe in history. But the last element of our forecasting always involves making some assumptions. That there's a given set of risks out there. There's no economic model that's going to tell me, will President Putin cut off natural gas supplies to Europe this winter? We have to make some assumption around that. So these are, what I'm showing here is roughly these are all the risks that we're currently considering, or we think are worth highlighting, and we organize them according to what we think is the likelihood of those happening. That's the vertical axes, and we also focus on what the potential severity of that shock is from high to low. So where we don't want to see things is in the upper right-hand corner. That would mean high likelihood and high severity. So luckily, there's nothing up in the top right at the moment. But if we look sort of ringing around that area, Eurozone energy crisis, housing market correction, accelerating inflation, crisis of over-leveraged households. a lot of these risks tie together. As I was sort of hinting at before, the most likely scenario at which the economy ends up in recession is inflation accelerates for whether that's military conflict, supply chain issues, COVID. Inflation accelerates. That causes interest rates to go even higher than we're expecting. That causes the housing market to start to unravel. You can think about maybe the Eurozone energy crisis is one of the sources of this accelerating inflation. And if house prices fall too much, and if we start getting lots of delinquencies and bad loans, you're talking about a sort of crisis of over-leveraged household situation, where the whole financial markets start to get a little bit wobbly, so similar to some of the things we see going on in the UK right now. So I'll pause there, and we'll open the floor up to questions that you guys have shared. So I think Craig is going to sort through them and send them over to me.
Yeah, Brendan, thank you so much. Very informative, very insightful, and always appreciate your time. There's two questions I'm going to read that they're somewhat connected. So would you say that, or what would you say is the probability of your forecast materializing? Are we sort of 95% sure that the market will depreciate at the peak in late 2023 or early 24? And the second part to that is, when would you say the appreciation will resume, and to what extent?
I showed the slide with our house price scenarios. And one of the things I was highlighting there was it's hard to see upside in prices right now. As I mentioned before, interest rates are working against house prices. The labor market's working against house prices. Everything that's happened over the past 2 years with the increase in valuations and the decline in affordability is working against house prices. To the question of will house prices avoid declines? I mean, in our RPS survey, we've already had 2 months of declines. This is more of the start. The question in my mind is more of how many of these declines are we going to get? And to that, I think I gave my hard definitive answer of 12%, though with some plus or minus on that. In terms of a resumption of price growth, prices are not going to pick up consistently until buyers return to the market in force. And I don't see a scenario where buyers start returning until interest rates start falling. And I say once interest rates start falling, that will lure buyers back in. We know there's people who wanted to buy a house, things got unaffordable, and they're sort of thrown in the towel and they're sitting on the sidelines. We are talking about unemployment rising, but we're talking about unemployment going from a record low to somewhere back to where it more historically normal. So buyers will come back as interest rates improve in 2024. But as I think as I started off saying, it's going to be a tough year ahead for the housing market.
Excellent, thank you. One other question that received, do you think the Bank of Canada will get it just right and not overshoot, as it is a bit of a tough tightrope to walk?
On the last slide there, talking about the BOC policy error. That was the one, risk matrix. That was the one risk we have rising. This idea that the Bank of Canada might go too far. Now that we're at 3.25% on the overnight rate, that is above the 2.5% natural rate. That is why we're highlighting this risk of Bank of Canada policy error, because the higher we go, the more chance there is that we go too high. This is an extremely challenging balancing act to pull off. you're trying to, increase interest rates just fast enough in order to get core inflation to slow down at, a steady pace, and do that without causing unemployment to rise too much. It's challenging. It's challenging. I don't think there's anyone out there who would get it perfectly. The question is, how close to correct, do they get it? I would, I think the conversation does need to shift a little bit more towards, is the Bank of Canada doing too much too fast? Unfortunately, I don't think that, that sentiment is going to gain, too much popularity or sort of too much support, until we, start to see, GDP start to stumble in the first half of 2023. So, as I said in my forecast, the Bank of Canada's last hike, January 2023, I think what underpins that decision is we start to see some more dismal high frequency data start coming out.
Awesome, thank you. One other question that we just received, do you have a point of view on the stress test?
On the Bank of Canada stress test, well, I guess unless you're a major London bank, you didn't have to participate in that one. I think it's fair, as you saw in our house price scenario slide, in our sort of most pessimistic scenarios, we put a peak to trough decline around 30-35% or so. That is, that number aligns fairly closely with the price declines we saw in the United States, national average during the 2008, 2009 global financial crisis. Which isn't to say that prices historically haven't fallen by more. In Europe during the global financial crisis, certain countries had prices fall as much as 50%. The difference between those extreme events and some of our downside scenarios is, in order to really amplify those declines, in order to get those really, really massive price declines, there has to be a financial system contagion. So if you remember those events, there were also multiple bank failures that occurred during those events that exacerbated all those problems. We do not expect a scenario like that for Canada. Canada's financial system is very well regulated compared to its peers. A lot of new regulations have gone into effect since 2008, 2009, which means the banking system is in much better shape, and we don't anticipate those such factors to arise where you would see truly horrific price declines.
Excellent, thank you. And one other that's sort of a part A and part B as well. If you were a consumer looking to buy a home, when should you buy if timing is not an issue? And part B, let's say you're in Calgary, would that answer change?
Yeah, well, I will say I am in this situation. My wife and I are now expecting child number 3, and the home is about to feel a lot smaller. I looked at the options of buying a new house and was obviously depressed with what I saw, as I imagine maybe other people in a similar situation might have felt. I've actually personally made the decision. I think we're actually going to renovate our home and try to get some more space. It's sort of, you're trying to make some of those sort of temporary adjustments to get through this tough environment. So the question is, when is it going to start getting better? Even, so where does I think this is a good point where, where does our forecast, differentiate, a bit from the consensus, and where does it differentiate a little bit from what, the Bank of Canada is saying? If you take what the Bank of Canada and the U.S. Federal Reserve, if you're taking what they say to heart, they are saying, interest rates are going to, stay elevated, pretty much to the end of 2024. I don't see them being able to hold interest rates that high for that long. Historically, they haven't been able to do it. And if the economy is going to be weakening the way we think it is, they're not going to be able to maintain that overshoot for a long time. What does this all mean in terms of, when's a good time to buy a house? Probably once, after these price declines have, worked their way, through the different metro markets. So after the price declines have taken place, 2023, and then when interest rates start falling in, 2024. So I would pin to, as I said, when do we expect buyers to return? Early 2024. In terms of, if your, push comes to shove and, you want to buy a house, you're certainly going to favor those, much more affordable markets, like Calgary, like some other places in the prairies. Is it a good time to buy? Well, as I was showing in the presentation, we're not. I guess if you're thinking about it purely from an investment perspective, we're not expecting price declines in Alberta. So I guess you could consider it an outperformer.
Excellent, thank you. And one last question. Would you advise consumers buying now sort of fixed or variable rate?
I would advise people to get a fixed rate. Because in that, 2 points. First is, I don't think if you believe in our baseline forecast, there's not a ton of risk in the variable rate because a lot of the increases in interest rates have already been baked in. I quoted the 5.6% 5-year rate in August. Rates are already higher than that. So, under the baseline forecast, if you took a variable rate mortgage, there's not going to be much more increase in interest rates. And then, you would enjoy the benefit in a few years of the interest rates starting to come down. That being said, the risks for interest rates are much, much more weighted towards the upside. And so, the downside scenarios we were talking about, if you believe that, inflation isn't going to get back to normal, as fast as I said it was, then interest rates are going to go higher, and then you potentially would be in trouble. So it's not that I think if under the baseline that's a bad decision. I just think you're exposing yourself to a considerable amount of risk because the risks are that interest rates are going to go higher.
Excellent. A big thank you to Brendan for your interesting insights and sharing your knowledge. Always appreciated. And thanks to you, our audience, for joining us and participating in this session. As noted before, soon after the webinar, we will share the webinar recording, the presentation deck, and the latest forecast report. And immediately after you log out, we'll provide you with a quick survey so you can get your feedback on what you liked about the webinar and perhaps what we can improve upon. And feel free to connect with the RPS or Moody's Analytics team if there's anything we can help you with. I will mention we also have a couple other webinars coming up. The Economic Power Panel with Benjamin Tall, Derek Burleton, and Robert Hogue, which is always great. And also Building Climate Change Risk Resilience into Home Financing. It's with Paul Kovacs, who's the Executive Director and founder of the Institute for Catastrophic Loss Prevention. You should receive invites to both, but you can also please visit our website for more information. And on behalf of RPS and Moody's Analytics, a big thank you to everybody.